All right, so we're diving into dividend stocks today. We're looking at an article called The Smartest Dividend Stocks to Buy with $10,000 Right Now. Maybe you just got your holiday bonus, or maybe you're just, thinking about what to invest in the new year. So this deep dive will help you figure that out.
Yeah, we'll give you the details and help you figure out if these stocks are right for your portfolio.
The two stocks we're looking at are Dell Technologies and Vici Properties. Now, these might seem like they're from completely different worlds. You got a tech giant and then a company that owns like entertainment venues and casinos.
Yeah. I mean, they're two very different approaches to dividend investing, right? You have Dell, which is all about growth potential, and then you have Vici, which is focused on stable income.
So, okay, let's understand these companies a little better first before we get into the, actual dividends themselves. Starting with Dell, the article really highlights their connection to the AI boom. But it's not just about riding the wave. I mean, how is Dell strategically positioning themselves within the AI landscape?
Well, they're not just providing the hardware, know. They're actually developing AI solutions themselves. They're really focusing on edge computing, which is bringing that AI processing power closer to where the data is generated. So you think about self-driving cars, for example. They have to make split-second decisions. So processing that data in the cloud isn't fast enough. So Dell is developing those edge servers that can handle that real-time AI processing.
So it's not just about these massive data centers we always hear about.
Right. The hyperscale data centers are really important, and Dell is definitely a major player there. But they're also thinking ahead, be distributed across a wider network. And, they've partnered with some key players in the AI ecosystem, like NVIDIA, to develop optimized hardware and software solutions.
Okay, so they're strategically, putting themselves in a position for long-term growth in the AI market. The article mentions their infrastructure solutions group saw a big jump in revenue. Was that all driven by AI?
Not entirely, no, but AI is a big factor. I mean, their server networking sales were up significantly, and that's directly tied to that, growing demand for AI infrastructure. But they also have a strong presence in other areas like data storage and cybersecurity, which are also benefiting from this whole digital transformation trend.
Okay, so they're making money. But what about sharing that with investors? The article mentions shareholder-friendly policies. What does that actually mean for someone who might want to invest in Dell?
Well, it means that Dell is committed to returning value to their shareholders through dividends and stock buybacks. Their goal is to return 80% of their free cash flow, which is that cash left over after covering their operational expenses and capital investments.
Okay, so 80%, that's a pretty big chunk of their cash flow. Sounds good, but haven't there been some concerns about Dell's debt levels? How does that affect their ability to keep up with those shareholder-friendly policies, especially dividend growth?
Yeah, that's a good point. Dell does have a lot of debt, which is definitely something potential investors should think about. It's important to look at their debt management strategy and make sure they can handle their debt obligations while still giving back to shareholders. They've been working to reduce their debt. And their strong cash flow does make it seem like they can handle it, but it's definitely something to keep an eye on.
So kind of a balancing act there. Let's talk about dividends specifically. The article mentions Dell's dividend growth pledge. Can you explain what that means?
Sure. So Dell has said they'll increase their annual dividend by at least 10% through fiscal 2028. And this year, they actually did even better than that. Raising the dividend by 20%. Their forward yield right now is 1.26%.
So that's not a huge yield compared to other dividend-paying stocks. I mean, it's about the same as the average for the S&P 500, right?
Yeah, that's true. The thing with Dell isn't really the current yield, but the potential for growth. They're going all in on AI. And if that works out, their earnings and cash flow should keep growing, which will let them keep increasing those dividends. And remember, they've already shown that they're willing to go above that minimum growth target.
So it's a long-term play. The article also mentions that analysts are pretty confident about Dell. 21 out of 25 analysts recommend buying Dell stock, and the average price target suggests a 27% upside. What are analysts seeing that makes them so optimistic?
Well, they're looking at Dell's strong position in the AI market, which is only going to keep growing. They're also looking at their solid financials and their dedication to giving back to their shareholders. Plus, they're looking at the bigger picture. The hyperscale data center market is expected to add like 120 to 130 new centers each year for the foreseeable future. And Dell is in a prime position to benefit from that expansion.
Okay, so with Dell, we're talking potential for growth. A decent dividend with a promise to increase it, and a lot of positive opinions from analysts. Now let's completely switch gears and talk about Vici Properties. The article highlights their trophy properties. But what makes these assets really unique? I mean, besides just being well-known places.
Well, it's not just about name recognition. Vici structures its leases in a way that creates incredible stability and very predictable cash flow. They usually sign long-term leases, often with initial terms of 10 to 25 years, and they have built-in rent increases that make sure rental income steadily grows over time. Plus, they focus on tenants with good credit ratings, which lowers the risk of not getting paid even more. Think about it, even when everything shut down during the pandemic, and a lot of casinos and entertainment venues were closed, Vici still collected 100% of its rent. That really shows how strong their lease structures are and how high quality their tenants are.
That's impressive. Can you tell me more about how they pulled that off? I mean, considering the impact the pandemic had on the whole hospitality industry, did they have to make any compromises? Or was it purely the strength of those initial agreements?
It was mostly because of the way their leases are structured. Vici's leases are made to ensure rent payments. Regardless of how well the tenant is doing business-wise, they really prioritize the stability of the rental income stream. Now, there were some cases where payments were delayed, but those were usually just short-term things, with a clear plan for when the payments would be made up. In the end, their rent collection stayed basically unaffected.
So a very different approach than Dell's focus on growth. Vici prioritizes stability and predictable cash flow above all else, which makes sense for a REIT. But how does that translate into returns for investors?
Well, that steady cash flow lets Vici pay a really high dividend yield, currently at 5.5%. It's much higher than Dell's and the average for the market. And don't forget, REITs are required to distribute at least 90% of their taxable income to shareholders as dividends.
Right. That's one of the big things people like about REITs. But if you just focus on the yield, that can be misleading, right? What about whether they can actually keep paying those dividends? Vici isn't exactly a high-growth company.
You're right to bring that up. It's important to look past just the yield and think about whether the company can maintain and maybe even grow its dividend over time. A key thing to look at here is FFO, or funds from operations. It basically measures a REIT's operating cash flow, and it gives you a clearer picture of whether they can handle those dividend payments.
So how's Vici's FFO doing? Can they keep up with those big dividend payouts?
Well, Vici's FFO has been growing steadily because of their strategic acquisitions and those built-in rent escalators we talked about. This consistent growth in FFO means they should be able to keep paying those dividends and maybe even increase them over time. They've actually increased their dividend every year since they went public in 2018.
Okay, so their cash flow is growing consistently, which helps them maintain that high dividend yield. But how does Vici compare to Dell in terms of total shareholder return? I mean, Dell has those stock buybacks, which also give back value to shareholders.
That's a good point. Total shareholder return includes both dividends and stock price appreciation. Dell's stock buyback program definitely adds to shareholder return. And their growth potential could mean their stock price goes up a lot. But Vici's high dividend yield, combined with their history of dividend increases and a fairly stable stock price, also creates good total returns for investors. It really just depends on what each individual investor prefers and how much risk they're comfortable with.
All right, so we have two very different companies here. Dell, the tech company, betting on AI with a modest but growing dividend, and Vici, the REIT, focused on stable income and a high yield. It's decision time. Let's break down this choice for our listeners. What are the main things they should consider when deciding between a stock like Dell and a stock like Vici?
I think the most important thing is your investment goals and how long you plan to invest for. Are you hoping for fast growth and okay with more volatility? Or is consistent income and protecting your initial investment more important to you? Dell, being in the fast-paced tech sector, offers a higher chance of growth, but it also comes with more risk. Vici, on the other hand, gives you a stable and predictable income stream, but with not much growth potential.
So Dell is more high risk, high reward, while Vici is more slow and steady, wins the race.
Exactly. Your risk tolerance is the next big thing to consider. Are you okay with the ups and downs of the stock market, or would you rather play it safe? Tech stocks like Dell tend to be more volatile, while REITs like Vici are generally seen as less risky, especially since they focus on tangible assets and long-term leases.
So someone who doesn't want to take on much risk might prefer Vici, while someone who's comfortable with more ups and downs might like Dell better. What about things like dividend payout ratios? We talked about how Dell says they'll give 80% of their free cash flow back to shareholders. But what about Vici? Are there any worries about them being able to keep paying those high dividends?
That's a great question. It's really important to look at those payout ratios. Dell's commitment to returning 80% of their free cash flow is great, but their high debt levels mean we should take a closer look at whether they can actually keep that up in the long run. Vici as a REIT usually has a higher payout ratio compared to companies that aren't REITs. Their current payout ratio is around 85%, which is considered healthy for a well-managed REIT.
Okay, so both companies seem to have sustainable dividend payouts, at least for the time being. But what about their history of dividend growth? Past performance doesn't guarantee future results, but it can give us some hints about whether a company is serious about rewarding its shareholders.
Absolutely. Dell has that pledge to increase their dividend by 10% every year through 2028, and they already exceeded that this year. Vici has a consistent track record of increasing their dividend every year since they went public. Although the growth rate has been smaller, usually just a few percentage points. Again, it comes down to your investment goals. Is a high starting yield more important to you? Or is the possibility of faster dividend growth what you're after?
So Dell offers the potential for faster dividend growth, while Vici offers a higher starting yield, which brings us back to what each individual investor prioritizes. The article really emphasizes why NOW is a good time to invest in both of these stocks. What are their arguments?
They point to the current bull market, suggesting that it's a good time for both growth and income stocks.
Yeah.
They also emphasize the power of compound growth, which is especially relevant for Vici with its higher dividend. The sooner you start reinvesting those dividends, the more they can snowball over time.
Makes sense. But wouldn't you say it's always a good time to invest, as long as you're in it for the long haul, and you're choosing companies that are fundamentally sound?
That's a valid point. It's really hard to time the market perfectly. And being a successful investor in the long term is more about identifying those quality companies and sticking with them, rather than trying to guess what the market is going to do in the short term.
Okay, so trying to time the market might be debatable, but you can't deny the power of compound growth. Even if the dividend yield seems small at the beginning, reinvesting those dividends can lead to a lot of growth over time.
Exactly. And the article specifically highlights Vici's higher dividend yield.
Yeah.
Which makes it even more attractive for people who want to take advantage of compounding.
All right, so we've covered a lot of ground here. We've explored the details of both Dell and Vici, their financials, their dividend policies, their growth prospects, and even touched on some broader market trends. Before we move on, I want to hear your thoughts. What stood out to you the most from this comparison?
You know what's really interesting to me is how these two companies, even though they're in completely different industries, both offer really compelling arguments for dividend investors. Dell represents that growth-oriented approach, taking advantage of a game-changing technology like AI. And then Vici embodies that stability and predictability of real estate, producing a high and consistent income stream. It really highlights the wide range of options available in the world of dividend investing.
And that diversity is key, right? It shows how important it is to understand your own investment goals and risk tolerance before you make any decisions.
Absolutely. There's no one-size-fits-all answer when it comes to investing. What's right for one person might be completely wrong for someone else.
So how can our listener figure out what's right for them? What are some key questions they should ask themselves when they're looking at dividend stocks?
Well, they should start by figuring out their investment goals. Are they looking for income now? Growth in the future? Or a mix of both? What's their time horizon? Are they investing for the short term, the long term, or somewhere in between?
So someone who's getting close to retirement might prioritize current income, while someone younger might focus more on growth potential.
Exactly. And once they have a clear idea of their goals, they can start evaluating different dividend stocks with that in mind. They should consider things like how financially healthy the company is, their dividend payout ratio, their dividend growth history, their industry outlook, and their overall valuation.
So it's not just about chasing the highest yield or the fastest growth. It's about finding companies that fit their individual goals and risk tolerance.
Exactly. And it's so important to diversify their portfolio. Don't put all your eggs in one basket, as the saying goes.
Right. Even within dividend investing, you can diversify across different sectors, industries, and company sizes. That way you're not too exposed to any one particular risk.
That's right. Spreading your investments across different dividend-paying companies can help reduce risk and potentially improve returns over the long run.
Okay, so we've talked about the importance of defining your goals, figuring out your risk tolerance, and diversifying your portfolio. But what about the actual process of researching dividend stocks? Where do you even start?
Well, there are lots of resources out there to help investors research dividend stocks.
Financial websites like Yahoo Finance and Morningstar give you detailed information about companies' financials and their dividend history and what analysts are saying about them. There are also websites and newsletters that are specifically focused on dividends that offer curated lists of dividend stocks and in-depth analysis.
And of course, you can always talk to a financial advisor who can give you personalized advice based on your own situation.
Exactly. A financial advisor can help you make a complete investment plan, choose investments that match your goals, and give you ongoing support and advice.
All right, so we've given our listeners a good foundation for understanding dividend stocks and how to start investing in them. But before we move on, I want to go back to something we mentioned earlier, the article that started this whole conversation. They briefly mention a few other dividend stocks worth looking into if you have $10,000 to invest.
Yeah, they talk about Broadcom, another semiconductor company that's profiting from the AI boom like Dell. And then there's Procter Gamble, a consumer staples giant that's known for its stable and reliable dividend growth.
And lastly, there's Realty Income. They're nicknamed the monthly dividend company because, well, they pay out dividends every month. They have a diverse real estate portfolio, which makes them even more stable.
These are just a few examples. And it's always good to explore different options and see what fits with your own investment philosophy.
Okay, so we've got Dell, Vici, Broadcom, Procter Gamble, and Realty Income, a diverse mix of dividend-paying companies, each with its own strengths and weaknesses. What are some of the key takeaways you think our listeners should keep in mind as they start their own research and make decisions about their portfolios?
Well, the first and most important thing is understanding your own investment goals and your time frame. Are you looking for fast growth and willing to take on more risk? Or do you prioritize consistent income and protecting your initial investment? That will guide your decision-making process.
Right. And it's important to remember that these are just a few examples from a huge universe of dividend-paying stocks. Don't limit yourself to just these options. Do your own research, explore different sectors, and find investments that truly align with your personal financial goals.
Absolutely. And remember, investing is a journey, not a destination. It's about constantly learning, adapting to market conditions, and refining your strategy over time. Don't be afraid to ask for advice from financial professionals. Explore different perspectives and never stop learning.
I totally agree. Knowledge is power, especially when it comes to investing your hard-earned money.
Exactly. And, the article actually mentions AI and experiential real estate as these key drivers.
Interesting. So beyond just the, financial returns, are investors kind of like aligning their portfolios with their values these days?
Yeah, exactly.
Yeah.
Investors, especially younger generations, are really looking for companies that, show a real commitment to ESG, which is environmental, social, and governance factors. Companies that are leading the way in areas like renewable energy, clean technology, and social impact. Those companies could really attract a lot of investment.
So it's not just about making money anymore. It's about making a difference. It's like a whole new way of looking at investing.
Yeah, I think it's a natural evolution. As we face these global challenges like climate change and social inequality, investors are realizing that they can actually make a difference through their investments.
Okay, so we have AI on the one hand, this amazing technological advancement. On the other, we have this growing focus on sustainability and social impact. Are those two things in conflict, or can they work together?
I think they can definitely work together. In fact, they might even make each other stronger. AI can be a really powerful tool for tackling those environmental and social problems. For example, AI algorithms can, optimize energy use, improve how we manage resources, and even identify and reduce social biases.
That's really cool. So instead of seeing them as two separate trends, we could see them as interconnected forces shaping the future of investing.
Exactly. The most successful investors are going to be the ones who can find those companies that are not only, riding the wave of technological innovation, but also showing that they're committed to building a more sustainable and equitable future.
So for our listeners, it's not just about choosing between Dell and Vici. It's about understanding these bigger trends and finding companies that align with both their financial goals and their values. It's about looking past the hype and really understanding what's driving these companies forward.
Exactly. It's about doing your research, asking the tough questions, and making informed decisions that reflect your financial goals and your vision for the future.
Well said. This deep dive has given us so much to think about. From the specifics of Dell and Vici to these bigger trends shaping the investment world, hopefully our listeners are feeling inspired and ready to start their own research journey.
Remember, knowledge is your most valuable tool when it comes to investing. Stay curious, keep learning, and never be afraid to ask questions.
I couldn't agree more. And always remember to invest wisely, with a clear understanding of your goals, your risk tolerance, and the companies you're trusting with your money. Thanks for joining us on this deep dive, and until next time, happy investing. Drew. Now, before we let you go, I have one last question for you, something to think about. We talked about these specific companies, but what about like the bigger trends that are shaping the whole investment landscape? You know, the article mentions AI and experiential real estate as key drivers. Where do you see the most exciting opportunities popping up in the next few years?
That's a great question. I think it's important to look beyond individual companies and think about the bigger forces that are going to shape the market. AI is definitely like a game changer, and we're only just starting to see what it can do. But I'm also really interested in this growing focus on sustainability and, socially responsible investing.
Interesting. So, beyond just like the financial returns, are investors more and more trying to match their portfolios with their values?
Exactly. Investors, especially younger ones, are looking for companies that are genuinely committed to ESG, those environmental, social, and governance factors. Companies that are leading the way in things like electrical, renewable energy, clean technology, and social impact. They could really attract a lot of investment.
So it's not just about making money, it's about making a difference. It's almost like a whole new way of thinking about investing.
Yeah, I think it's a natural progression. As we face these big global challenges like climate change and social inequality, investors are realizing that they can actually use their investments to make a positive impact.
Okay, so we have AI on one side, this amazing technological leap forward. And on the other side, we have this growing awareness of sustainability and social impact. Are those two things like clashing, or can they actually exist together?
I think they can definitely coexist and maybe even complement each other. AI could be a really powerful tool for addressing environmental and social issues. For example, AI algorithms can help us optimize energy consumption, manage resources better, and even identify and reduce those social biases.
That's fascinating. So instead of thinking of them as separate things, we could see them as these interconnected forces that are shaping how we invest in the future.
Exactly. The investors who are going to be most successful are the ones who can identify the companies that are not only riding the wave of technological innovation, but also demonstrating a real commitment to building a more sustainable and equitable future.
So for our listeners, it's not just about choosing between Dell and Vici. It's about understanding these larger trends and finding companies that fit with both their financial goals and their values. It's about seeing past the hype and really getting what's driving these companies.
Exactly. It's about doing your homework, asking the tough questions, and making smart decisions that reflect both your financial goals and how you see the future.
Well said. This deep dive has given us a lot to think about. From the specifics of Dell and Vici to these bigger trends that are shaping the investment world. Hopefully our listeners are feeling inspired and ready to start doing their own research.
Remember, knowledge is power when it comes to investing. Stay curious, keep learning, and don't be afraid to ask questions.
I totally agree. And always remember to invest wisely. Make sure you understand your goals, your risk tolerance, and the companies you're choosing to trust with your money. Thanks for joining us on this deep dive, and until next time, happy investing.